Welcome to the Nichols Tax Update podcast. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value of my subscription to Tax Notes Today, the preeminent source of information for tax professionals in preparation of this program. And we have an unusual number of articles from Tax Notes Today in this week's program. Usually it's all about cases and rulings, and maybe we have one article from Tax Notes Today. This week I think we have three because they're on point, they're timely, and they're easy to read and understand. So what's in this edition? First of all, a reminder that NOL Carrybacks for 5 years are allowed by the CARES Act, but only losses through 2020. And we'll talk a little bit about that. Per diem rates for employees in transportation industries, airlines, railroad, trucking, etc. An IRS webpage to help marijuana business comply with the tax law. Talked a little bit about that last week. I want to talk about it a little more this week because it's really important. And apparently there are more and more demands for CPAs to assist marijuana growers and sellers and distributors who are all engaged in the marketing of a controlled substance. Then I ask you to consider the interplay between Code Sections 108 and 163J. So Code Section 108, income from forgiveness of indebtedness, and 163J, and limitation on the deductibility of interest. But what if accrued interest, which was not deductible, is later forgiven? Is it income or not? Next, are non-recourse loans, notice that's in quotation marks for a reason, to fund litigation income to the lawyer who, quote, borrowed the money. Final regulations define a qualifying relative in 2018 and 2025, and I want to make a point that's often overlooked here about who can be a qualifying relative. I call it the girlfriend rule. Pay attention. Next, federal tax liens survive bankruptcy. 2 weeks in a row, we have significant cases that remind us that federal tax liens are not extinguished in bankruptcy. They survive bankruptcy. The debtor no longer is personally liable for the tax, but the tax will be collected when the property to which the lien is attached is sold. Finally, to the point of you can't make this stuff up, right? A not-for-profit corporation tried to make an S-election, allowing one of its directors to claim almost $275,000 in losses as a shareholder. Well, nice try. That's all I can say about that. Now, notice this is extremely time sensitive, so heads up here. This is from Tax Notes Today on September 14th, a wonderful article by Harold May reminding us that the Coronovirus Aid, Relief, and Economic Security Act resurrects the 5-year NOL Carryback, which had been kicked to the curb by the Tax Cuts and Jobs Act, but only for losses in 2018, 19, and 20. So here's the deal. If you're having a bad year in 2020, but had profits and paid taxes in 2015, 16, 17, 18, or 19, do two things. Number one, be grateful for temporary renewal and extension of the 5-year NOL Carryback. 2, be sure to take all possible losses in 2020 that could yield a tax benefit from offsetting taxable profits in 2015, 16, 17, 18, or 19. This is where paying attention to these kinds of updates can really pay off. If you have only one client where you can take advantage of the 5-year NOL Carryback, it ought to be worth the time you spend with me every week. Next, per diem rates for the transportation industry. Per diem rates, as you know, are set for locations, and they are accepted as documentation for the expense incurred as long as you can prove that you are in travel status. But what about a guy or gal driving a truck? They're not in the same place all day. So we have special per diem rates for workers in the transportation industries. An airline pilot starts his day in San Francisco, he ends his day in Honolulu, Hawaii. Which per diem do you use? Well, you use the transportation industry's per diem for that airline pilot, and since he winds up in Honolulu, Hawaii, and that's a high-cost location, and it's outside the continental United States, his per diem is $71. If he flew from San Francisco to New York City, he's still in the continental U.S., his per diem is only $66. But if the airline already reimburses him for his expenses, or if the airline gives him a per diem, can he get any more money? Yep, $5 for just incidentals. Now, what if he gets no reimbursement from his employer at all? The high-low daily rates are $292, including your hotel room in high-cost locations, and $198 in low-cost locations. And remember, the per diems are accepted in lieu of actual detailed records, provided that your employer adopts a policy of reimbursing certain employees on a per diem basis. Website dedicated to tax compliance in the marijuana business. Tax notes today, again this week, reminding us that of all the emphasis that's being placed on complying with the tax law, even though you're breaking other parts of the federal law. 6 questions and answers. Do I have to pay payroll taxes? Yep, like anybody else. What if I pay late, or what if I have underpayments? Penalty? Yep, like anybody else. Penalties? Exactly like everybody else. How about Section 162 deductions? Ordinary and necessary expenses? Nope, 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 none. Not like anybody else. Because you're engaged in an illegal business, you can't claim any expenses, but you do have to report the income. What about handling cash? Cash in. You report like everybody else. If someone comes in and buys some really good Mary Jane, and they give you more than 10 grand in a single transaction, or someone comes in every day, over several days, and you get more than $10,000 in a week, you're going to report that as a cash receipt in excess of $10,000. What about cash out? Well, I'll tell you what, you better have ironclad documentation for all of your expenses. That you paid some stoner to drive a truck and deliver the marijuana, but failed to get a receipt is probably just a, what would that be, an occupational hazard? Business interest limitation and income from cancellation of indebtedness. This is one of those places where different provisions of the tax law collide. This is an article by Eric Yauch, who writes a lot for tax notes today. Cancellation of indebtedness income is certainly more likely in the current economic downturn and may in fact be in larger amounts. Could forgiveness of accrued interest for which a deduction was deferred under 163J give rise to COD income? Well, it could, but it shouldn't. It should be treated, and I've got this in the negative. Should it not be treated? That's a pompous sounding thing. Should it not be treated as reducing any excess business interest carryover? Well, it should be treated as reducing an excess business interest carryover. That would be ever so much more fair. Here's a lawyer who was his own tax lawyer. He drafted loan agreements and notes that failed the asset test for what is a loan. This is an article by Robert Wood and Donald Board reporting a case which would be cited as Novoselsky. David Novoselsky was a litigation lawyer. He raised $1.4 million using loan agreements, and you notice that's in quotation marks, loan agreements that he drafted himself to finance his lawsuits. It takes money to pursue these lawsuits, and until you win one or two big ones, there is no money to fund the ads or the office or anything else. But here the tax court found that David's documentation did not meet the 7-factor Welch test for what is debt. You know, the tax law has been developing for a long time, and the Welch test is 7 factors to determine whether something that purports to be a loan really is a loan. In this case, there was no written instrument that met the qualifications for a note or a loan agreement. There was no stated rate of interest. There was no repayment schedule. There was no collateral. There were no interest payments made. There were no principal payments made. There was no conduct of a type expected in a debtor-creditor relationship. The court concludes these amounts were not loans. They were income to the attorney when they were received. He had a non-recourse provision that he wrote into all these agreements that simply went too far. The court said those loans were basically forgiven ab initio. Well, that's a fancy term. It's a legal term. I always look those things up. It means at inception or in the beginning. It meant that when they signed those documents, they never were loans because the non-recourse provision basically forgave the loan up front. Who is a qualifying relative? Now, if you weren't paying attention before, please pay attention now. This is a sleeper. A lot of people miss this. Why do we care? Well, we care because we can get a tax exemption for a qualifying relative. An individual may qualify as head of household if maintaining a home that includes a qualifying relative. Now, I call this the girlfriend rule. Why do you think I would call it the girlfriend rule? Am I suggesting that a girlfriend, someone to whom you're not married, or a boyfriend for that matter, someone to whom you're not married, someone that is no way the traditional relative, an in-law, an outlaw, whatever, a cousin, could possibly qualify you for head of household treatment? Yes. Follow along. The exemption amount for a qualifying relative is based on inflation-adjusted Section 152D1B exemption amount in annual revenue procedure setting out inflation-adjusted amounts. That amount is $4,150 for 2018, $4,200 for 2019, and $4,300 for 2020. But that's not the main benefit. The main benefit is back up there at the top of the list. It's that you could qualify as head of household if you're maintaining a home that includes a qualifying relative. I live here in Florida. We have a lot of circumstances where a residence is 2 persons who are not married, one of whom works, has a good job, or is retired and has a good income, and the other is simply good company. How does that work? Here we go. What you're going to find is labeled relationship test, but it isn't necessarily a relationship. It is a relationship, but it is not necessarily going to be the traditional familial relationship to which we're accustomed. Let's start. You meet the relationship test. Now, the income test is the same. The relationship test, a descendant or ancestor of the taxpayer, we get that. A sibling of the taxpayer, including stepbrother or stepsister. A son or daughter of the taxpayer's brother or sister. That's a typo. Not brother of sister, but brother or sister. Not cousins. A sibling of the taxpayer's mother or father. That is my aunt or my uncle. An in-law, mother-in-law, father-in-law, sister-in-law, and brother-in-law of the taxpayer. Or, and if I had the right, if I understood how to make this thing work better, I'd have my or in flashing lights, right? Or an unrelated person who lives in the taxpayer's home the entire year. If the unrelated person meets the income test, the relationship test for qualifying relative does not in fact require the person to be a relative in the traditional familial sense. That's what a lot of people miss when they're reading the rules on who is a dependent. It is the bottom line, the last line in the code paragraph that defines relationship test is the unrelated person who lives in the taxpayer's home the entire year, qualifies the taxpayer to take head of household status rather than single, and that can make a big difference in your tax liability. Federal tax liens survive bankruptcy. We learned something about this last week. Here it is again. 2 cases in 2 weeks. United States versus Russell Webb. This is important because we expect a wave of bankruptcies resulting from the coronavirus economic slowdown. Federal tax liens attach when taxes are assessed. The IRS does not have to go to the courthouse and file liens. The lien arises when the taxes are assessed, and it attaches when the taxes are assessed, and those liens are not extinguished in bankruptcy. The IRS may release those liens. The IRS may release those liens for administrative convenience, but may reinstate those liabilities and refile liens at any time before the running of the 10-year statute on collections. And so don't make the uneducated, unprofessional assumption that tax liens are extinguished in bankruptcy. They are not. Okay, got to have a laugh, right? Not-for-profit corporation cannot make an S election to pass through losses. This is a U.S. tax court decision based on Kentucky law. In 2012, Mr. Deckard bankrolled a not-for-profit corporation whose project, a fashion show in Louisville, Kentucky, or a series of fashion shows, failed, and his front money was lost. In 2014, looking for ways to get maximum benefit, Mr. Deckard attempted to have his not-for-profit corporation make an S election retroactive to inception. That didn't work because state law, Kentucky, forbids any distribution of profit from a not-for-profit corporation. So, the tax court reasons, the same limitation applies to distribution of a loss. They never had to get to the S corporation issues here. I thought it was a hoot. Like I said, you can't make this stuff up. Reading cases and rulings, reading learned treatises is always amusing and always informative. Thank you for joining me this week. Let's see. I think that's it. Until next week, it's me signing off. Wishing you the very best and reminding you, please, stay safe.